sir, Delhi, I don't mind. You need to help me. If you can get me crowd, I can do it, sir. Okay. Quickly share my screen as well. Some of the questions we have done this already, by the way, but let's start from the scratch so that it is easy for everyone. Let me put this into the full screen mode. Take your time, don't rush. What we will also start doing is, if you have any questions, some questions are very self-explanatory, but some questions are like, a little tricky. What we will do is, we will take time to go through the concept before revise the concept. Okay. So the goal here is, by the end of this class, you should be comfortable in answering any questions in chapter 3 of equity derivatives and chapter 3 of interest rate derivatives. Okay, cool, guys. Perfect. Okay, we have done this, but I think let's go through this one more time. Don't jump, but like you can go through this. Okay. Okay, the first one, right? After the initiation of futures contract, the price of the underlying asset has risen, right? In this situation, what will happen? Perfect. Everyone, please attempt it. And if you have any questions, please stop me. All got it correct? What is the answer, sir? D. Sir, I'm in full screen only, sir. Actually, you can't see my full screen. I'm in the full screen mode only. Everyone can see my full screen, right? No?
Yeah, actually, we can see the next slide is also appearing on the right side. So that is the reason the screen which you are displaying is actually showing. If there is a possibility, maybe you can stop slide to be displayed.
Okay, is this good?
Yeah, perfect.
Is this good? Okay.
This is better, sir. This is perfect.
Perfect. Okay. Okay. Perfect. The answer is A. Sorry, the answer is D. What are we saying? The price of the contract has gone up. That means the long position becomes profitable. Okay. Next, quickly. Trader buys the stock at 768. Lot size is 1200. What is his profit or loss? If this creates of your position 778. We have done this, but we'll just quickly repeat this. So here, what happens in the questions is sometimes they will ask you, I have taken a long position, I have taken a short position, but in this instance, they haven't asked anything. So he has taken it, bought it at 768, squared it off at 778, which means 10 rupees profit. So 10 times 1200 is, 12,000, right? Yeah, 12,000 is the answer here. Too easy. Cool. I don't know whoever has done this annotation. Please kindly can you remove that at your end? Okay. Trading is allowed in the Indian markets in which of the following? We have done this again. All yes. Individual stock options. We'll quickly go through. We'll increase the space here. Can one sell assets in the futures market even if it does not own any such assets? The answer is yes, right? Just quickly revising the concept here. What is forwards and futures all about? Forwards and futures are the contract that we will write for the near future, and there is no exchange of the currency, or neither there is exchange of commodities that will happen now. When we are entering into the contract. So I can even actually sell the futures in the market even if I don't any assets. Okay, so the answer is yes. Don't get confused at all. Okay, futures, forwards, you're not owning anything. Okay, that's a simple rule. Quickly, we have done this again. Derivatives market, this is about the calendar spread, right? And I think one formula here you can remember is n into n minus 1 by 2. Because since it is 3, it is very easy. But in case if you have 5 calendar spreads, it becomes very difficult, right? So if it is 5 calendar months, n into n minus 1 divided by 2. So 5 times 4 divided by 2, which is 10. In this case, n into n minus 1 divided by 2, it is how much? 3. Okay. Clear, guys? No one. And n into n minus 1, n into n minus 1 by 2. N is the number of, months there. Navya ma'am, you got it? N into n minus 1. Let me put it here. 5. Perfect. Everyone got it? Please stop me anytime if you're not getting it right, or if you want any clarification on any of the topics there, right? Next. Yeah. Milan has bought a futures contract and the price rises. What happens? What happens? He will make a profit. Very simple. B, how come B? No, sir, there should not be B. He's bought a futures contract and the price rises, right? So it's a long contract, he will make a profit there. Perfect. Okay. Next one. Kavita wants to sell on a futures market. For what does she has to do? Just now explain. Very good. Got it, right? In the futures, you need not own anything on the underlying part. Okay, please don't get confused. This is all, it's not at all tricky. They try to make it like tricky, but it's not. For if you have to sell anything on the futures market, you need not own any underlying, whether you have to buy or whether you have to sell. Okay, the same concept that we discussed just like 2 minutes ago. Okay. Next one. Calendar spread in index futures will be treated. Okay, what is this? We discussed this. Right? Everyone remember the calendar spread? What happens? 1, 2, 3 months, by July month gets expired, then what happens? My calendar spread is between July and August. My July month contract gets expired, the August month is actually called as a take-it position. Okay? We discussed this multiple times. Perfect. Most of you got it. Next. Identify the contract which is cleared and settled bilaterally. Get this one correct. I think we discussed this. This is based on the discussions that we had also, right? What did we say in this day one? Forward contracts are always settled bilaterally, right? Future contracts are always standardized, right? So here, even if you don't know the answer, right? Let's try to eliminate the what I meant to say, the options. What is Nifty future contract? Is Nifty future contract settled bilaterally? No, right? What is bilaterally between you and me, right? Or between two parties. So you can remove that. What is 1 month USD option contract? It's a currency contract. It's also not settled bilaterally. It is settled on the exchanges. Remove that. Now, third one, interest rate derivatives, GBO bond futures. We studied that. Remove that. So what are you left with? And he specifically used the word forward contract there. That itself, there is the answer. Got it? Even if you don't know the thing, if you spend little bit of a time going through the word by word, you will be able to answer it, by just by eliminating. Okay. Forward contracts are always settled bilaterally. We discussed about ITC example. We discussed about the gold shop example, multiple examples there. Okay. No one should get any, what I mean to say, you should not get confused. Okay. Next one. It is common to have derivatives contract without any expiration date. Perfect. You all got it. False. Please keep attempting. Please keep attempting. Anyway, I will upload this, but please keep attempting. There is nothing like right or wrong. How can you close a short position in futures market? Only in the chart, please. Don't unmute yourself for now. How do you close a short position in the market? No. People are getting confused, So let's go through the concept here, right? See, if I have a short position, what does it mean? I need to negate it, right? So that means I will purchase the same, future contract. I will take a buy position in it. Okay. Futures. See, some people have mentioned, a short position and buying a call option, that is hedging. Okay, that concept is hedging. I'm not doing hedging here, right? Now, the second thing is by entering into a suitable forward contract. What is he saying? Forward contract. Again, guys, most of the questions can be done by elimination only. When we are talking about futures, he's talking about contract. Is there any comparison? No comparison, right? So eliminate B. Okay. Now, he's saying by let's go to D, executing the sale of the same future contract. Are I'm looking to close short position. What will I sell them? I can't do anything, right? So what is the answer? If I have to close a short position, I have to buy a similar contract and close the position so that both are negated. Everyone got it? So the answer is C. Now clear. A is hedging. 2 is super nonsense because we are talking futures and forwards, no relevance at all. D, he is saying he wants us to repeat again what has been done, in the D. So eliminate A, B, D. Answer is C. Clear. Okay, even from the concept perspective. Got it, guys? How to do that even if you don't know. Perfect. Let's quickly move on. It's a lot to do. Okay. Trader sells futures contract and the prices rise. The trader will. Sir, don't jump. Please go through that. Some are putting B. B is not the answer. See,
make loss.
Yeah. Trader is selling a future contract, and instead of the price coming down, the price is going up. He will actually make a loss. Okay. Don't jump. Okay. Please read through that. Okay. Higher flexibility in fixing forward contract specifications compared to futures contract. Just now we discussed. Obviously, right? Future contracts are no, sir. Ashish, sir, why are you getting it wrong? No, guys, why are you getting it confused, right? Future contracts are standardized contracts. Forward contracts are not standardized contracts. What is it? What is he saying? So that means there is higher. Guys, please don't talk when I'm talking, please. So there is higher flexibility, in the forward contract specification, right? So the answer is true. Okay. So whoever wants to speak, go ahead, please. Whoever wants to speak, go ahead. Yeah, thanks. Okay, perfect. Let's not move on.
So can you explain it? I didn't get exactly what it means.
Sir, what did we say? You are there from class 1, no, sir?
Yes.
Okay, sir, we took the gold example. No, what is that? Forward. What is forward contract? It is between contract between two parties. There is no standardization. No. So if there is
Okay.
no standardization, what happens if you and I are the party? We can change the contract as we like, right? So that is the contract has lot of flexibility to change.
Flexibility.
Right?
Correct.
That is what he is asking. No.
Okay.
What is
okay.
happening
okay.
with future contract? Future contracts are always standardized contracts. It is on exchanges. The cash is, the everything is settled by the settlement mechanism, etc. and all that, right? So is there any
Right.
flexibility in changing the contract there?
No.
That's the question.
Correct.
Got it, sir?
Thank you.
Bingo. Let's move on quickly. 14. Open position can be settled. Nice. Okay. Always remember, most of the positions are actually settled as cash settlements. No, it's actually cash settlement on maturity actually. Okay. See, what actually happens is ideally there is delivery of maturity as well. Ideally that is the scenario. I think Arun sir, I got what you're trying to say, right? But ideally, what happens in the markets is, say for example, I have opened a futures contract. Now, what did we say? No, I have guys, just listen to this, right? Say when I opened the futures contract, we've seen that on the our brokers as well, right? Imagine the margin paid is only 1.2 lakhs for me. Okay, I'm in the contract till the end of the month. So what happens when the contract has to expire? I have to pay the entire amount, right? Whatever the 6.5 lakh or 7 lakh or whatever is the price at that point of time. What generally happens is most of the time, the brokerages actually square off your contracts, because they can't come to me and then say, Kiran, pay that 7.5 lakhs or take the delivery there. That doesn't happen. So like those positions get squared off. The answer is, especially for the exam perspective, is everything is settled by cash settlement on maturity only. Okay, there is no concept of delivery. Even though ideally that should be the case, but you're getting it. Perfect. Next. So you're seeing it, right? It's only the forward future concept that we discussed. They are doing jugaad with the questions, nothing else. What you need to do is you just need to read through, nicely. That's it. Future prices are usually more transparent than forward price. Absolutely yes. That's what we were saying, right? Standardization, standardization, standardization. Answer is yes. Near one future contract me. Near month. See here, what you need to do is, you just need to read through that, thing. But I think you'll get that. No. Most of you are getting it wrong. Near month is the current month, by the way. Answer is actually A here.
Near month is the next month, right? Far month is the next to next
For
month, right?
month is like, after 3 months.
Third month.
Okay, wait,
Third month.
let me repeat that. 3 months. Actually, near month is 6 months only.
Current month is the just
Next
it
month
is
is this month.
year month.
Next month. Next near month is the next month.
No, we have three contracts: near, next, and far.
Far month
Yeah.
is the third month.
Near-
That's
Yeah,
what I
yeah. Sorry,
understand.
near is this month current. Okay, what did I say?
Near is current month only. Near,
Near
next,
is
and
current
far.
month only. No, that's what I
That's
said.
what
It's
I
told A.
argument.
Yeah. The answer is A here. Okay, let's repeat the concept a little bit
So
here.
current month is the right July. Near month is the next.
Just give me 1 second. Okay, guys. Okay, don't get confused. I think we will repeat the concept here a little bit. So the contract cycles are of 3 months, right? Now we have discussed that. Okay. So the current month is called a near month. Okay, that means July month is near month. Next month is, what is it? August. For month is October.
Far month.
Okay. Near month is this month.
Got it.
Next month is August. For month is September. Okay. July, August, September. Near, next, for. Please
Next
remember
far.
this. Okay. So near month is actually the current month of the futures contract. Got it, guys? Only remember this: near, next, for. Okay. No
Far.
current. I mean, someone was saying current, and there is nothing like current month. Okay. Near, next, and for from the terminology perspective. Clear? We should not get this wrong.
Okay.
Good, guys. Okay. Perfect.
Yes.
Next one. See, sometimes we do mistakes, but we need to rectify then and there. Okay. So, yeah. Go ahead. Quickly. Yeah. Everyone got it correct here. Basis is the difference between spot and the futures price. Okay. It's very simple. Okay. One of the reasons future trading has become expensive due to higher margins. True or false? True.
True is also false as well, sir. Margins can
From the exam perspective, the answer is
always,
true, sir. Go with true.
if you have to take delivery rather than playing the margins always.
From the exam perspective, the answer is true. Okay. Yeah. Risk of a bad delivery in index futures contract. This is exactly the concept that I discussed just 2 minutes ago. Very good. Lovely. Everyone got it here? I just discussed this concept, just in 2 minutes before. What is the risk of delivery in index futures contract? There is no risk. Why? We're squaring off the contracts and we're settling on a cash basis, right? There is no concept of delivery ideal. Got it? Everyone got it? This does not exist. Okay. Take care, sir. Arun, sir. Yeah. I'll share the recording. You can go through that. Yeah. Okay. Next one. When does the monthly series for the index futures? Yeah, this is little tricky, everyone. I don't know. Yeah.
So as per the books, it is last Thursday, but it is in reality it's Tuesday as well. So
So if he gives that, if he gives Tuesday, go for Tuesday. But if he gives Thursday, go for Thursday. We can't do anything. Because in the options itself there is no Tuesday. So where will we pick up Tuesday, right? So go for Thursday.
Yeah, from exam point of view, it is Thursday.
Yes, correct. That's correct, sir. Next one. Long position in future market can be reversed only with the same counterparty from whom the contract was initially purchased. False, right?
False.
False, Nimai sir. It's false. Okay. Okay. Just do this. Thinks the markets will go down. He will sell 10 lots of index futures at 3,500. Predictions come true, index falls. Ganesh buys back the futures at 3,410. What is the profit he is making if the one index lot is 550? It's very easy. Yes, very good. Lovely. Nice. Cool. I think most of you are getting it correct. So 3,500 minus 3,410, 90. 90 times 50, 4,500. 4,500 times how many lots?
1,000.
I have 10. No, 10. So 45,000. Okay. So always remember the number of lots and what is the index size. Okay. So sometimes what he does is, he will actually give you 4,500, 450 also. In the answers, people generally tend to go. You have to calculate the lot size times the what I mean to say number of lots as well. Okay. Okay. Next one. Futures contract. Quickly. This is what we've been discussing. Someone please close the annotation. I think, I don't know, someone is actually playing with it. Okay. Most of the times in NISM exams, whenever the question is all of the above,
Which are the
all of the above.
true.
Yeah. Right.
Probability is
Corporation exchange, standardized contracts, and traded on exchange. I don't know who gave that nice laugh though, but yeah. Most of the times when it is all of the above, it's all of the above. Yeah.
The options here are pretty straightforward when it comes to the actual exam, right? So they give A, B, C, D as like 1, 2, 3, 4, and they're saying 1 and 2 are correct, 1, 2, 3 are correct, only 2 and 3 are correct, none of the above, something like that. So it's little tricky. That's how the exam pattern is.
No. Those questions, when it comes, see, if you're seeing these questions and it will come in this format only, don't worry, right? 1 and 2, 1, 2, 3, and all, we will do that. So those things that you will actually mostly see in research analyst exam, and in fund manager exam, and in investment advisor exam. Okay, so those exams are little tricky, but when it is all of the above, it's all of the above. We will go through that, if we come to that, don't worry. Okay, you got it right. Everyone got it. Next one. Calendars for transaction, trader takes two opposite position, two future contracts. This more of little bit of theory. Please get this correct. We did this before. See, lovely. It's two different delivery months and the same underlying asset. Okay, the answer is C here. Okay, cool. When a seller short sells a stock, it means again the same concept. Ulta palta kata karke, right? It's the same concept. Nice. Whatever it does, right? It does not own the stock. He's supposed to tell him. Okay, cool. Simultaneous purchase and sale of two different tenures, future contract in the same underlying is known as yes, lovely. It's called spread trade. Okay, we discussed that. Who are the three main participants that we discussed? There are hedgers, there are speculators, and there are arbitragers,
Arbitragers.
right? So this question actually is asking who is an arbitrage. What does they do? They actually purchase and buy and sell the same future contract of the same underlying. Okay, so spread trade also stands for an arbitrage. Okay, it's not long hedge, short hedge. It's not So those two are what they are saying. They are hedgers. Limit order, first of all, doesn't even exist. It's in a little not, instead of saying arbitrage, he's giving spread trade. Got it, guys? Everyone clear? It's not D, sir. It's C. Spread trade, arbitrage trade. We discussed about the market participants, no? If you all recall. Three participants. Okay. Don't worry, and you can practice this again. Okay. Whenever there is closing by transaction, this will have the effect partly or fully of the offsetting. Simple thing. What are they trying to do? They're actually closing a buy transaction, which means the opposite transaction should happen, right? Which means what? Guys, answer.
You need to close, you need to sell that as well.
That means what?
B.
Yes, I have to take a short position. Nice. Perfect. Got it. Most of you are getting it nice. Okay. Cost of carry model formula. Discuss this multiple times. Simple thing. I have taken multiple examples. We are putting gold with the gold guy. He has to put it in the vault. There is an insurance cost there. Okay. So what is the futures price for me? Spot plus cost of carry. Right. Go back to our gold example. Always remember that gold example there. From there you can derive. Even if you don't remember, even if you don't by heart or whatever. Got it. Everyone got it. Nicely. Lovely. Okay, do this please. Sir, you're jumping. Do this. Yes. Nice. Okay. Most of you got it correct. So what is happening here, guys? Just follow through this. Whoever did not understand, he's selling the future contract at 745, and he's actually buying at 754. So ideally, what is happening to start with in the first place, everyone? There is a loss, right? So if I'm selling a contract, what should happen? The price should actually come down. It should actually come down to 730, 725. Then I will make a profit. in this scenario, what is happening? 9 rupees I am loss I'm making. So 1500 times 9 is 13,500. It's a loss here. So the answer is B. Okay, guys, got it? First, you determine whether I'm making profit or short. Then the calculation becomes very difficult. It becomes very easy. Forward contract is, discuss this again. Nice. It's a bilateral commitment between two parties, right? Next. See, most of the numericals, in the exam will be this. Don't worry at all. By next week, I think we should be able to complete everything, and I'll give you the MFD material. Once you go through that, you should be able to attempt that exam in the month of July itself, or whenever at your convenience in the first week of August. Okay, the answer is what? C, 3,45,000. Most of you got it correct. Okay, simple, 6,900 times 50, nothing else. Next, it's same thing. Well, let's not do that. In opening buy transaction, the effect will be of creating or increasing. Nice. When I'm buying a transaction, what am I doing? I'm actually opening a long position, right? The answer is C. Everyone following, right? If you have any questions, please stop me so that we will revise the concept. Okay. If you have any questions, it's all very simple, but stop me. Yeah, go ahead.
Sir, can you erase the line?
I don't know, sir, who did that. It's not even me.
No,
Wait, let
it
me
is
see.
possible from your end.
I think it should be there. Are you all seeing those lines?
Yes, we are seeing.
Yes,
Wait.
It is disturbed. It makes some disturbance.
Yeah, I
Attendances
know.
goes
I
there.
don't know who are, I don't know if they've done that. Just give me a second. Go to my room.
Eraser.
Someone said that before as well.
Eraser in front of paste.
In front of कहाँ पे sir?
पेस्ट के सामने है इरेजर, वो शायद वही होगा. पेस्ट के नीचे क्लिप बोर्ड के ऊपर.
Okay, wait. I thought it. Oh. Sorry, sir. Guys, please don't use your annotations. Yeah.
So it is okay.
sir. Please turn off annotations, sir.
It is okay now, sir.
So that no one will do it.
That's what I'm trying to see. Where do you do that? I never did that. Okay.
Bluetooth mode has been on.
Okay, perfect. Let's move on. Hopefully, I think it should be clear. Sorry. You're able to see my screen, right? Someone did that again. Okay, I think it's not visible. Okay, fine. 32. This is clear, right, guys? Good. Hello.
Yeah, this is clear.
Okay,
Yes,
perfect.
sir,
Long
okay.
position is done. Okay, 34. Why are margins for calendar spread in index futures low? Okay, the answer here is, the answer here is the market. Sorry. Okay, the answer here is the market risk is actually low in the calendar spreads. The answer is C here. Okay.
C, right? Market risk is low.
Correct. The answer is C. Correct. Yeah, most of you got it correct. Okay, next one. Okay, the contracts which have been initiated but are not offset by subsequent sale or purchase by making or taking delivery are considered as
Square of position.
Clear position. Squared off.
No. Why squared off? Squared off matlab what? I'm closing the position, right?
That's open position.
Open
Still open
position.
position. Still open
Yes,
position.
correct.
Position.
They're called open positions. The answer is C. Okay.
So 34, so you said
Ah.
the low risk, but it's if you are taking that, for example, you're taking July and August, but it's the risk is there, right? If you're going against your what is the view, still the risk is there, right? But why it
Very
is low
good.
risk
Actually,
then?
no. I will teach you when we do the, the bullish spread and the bearish spread, as part of the strategies. Okay. What happens is, so the comparison here is, that's a very good question, right? So for example, if I'm only taking a naked position, like, either a short or a long, generally what happens is my margin will be very high. Okay. So to
Agreed.
mitigate that, what I will do is I will actually take a, another position so that see, what did we say in an options, in the options, my goal is always to mitigate the risk, right? And, hedge it and then at the same time make money. Because what happens in futures, there is unlimited potential and there is unlimited loss. Okay. So
Yeah.
I mitigate this by using that positioning there. We will discuss this when we talk about bullish, bearish spreads, straddle and strangle. How the, how you take the call put and how your margins will generally, sort of come down there. Got it?
Okay.
See, this is like, when you take in actual position vis-a-vis, like, what happens in the calendar spread. So that's what you have to compare to. Okay. Let's
Okay,
quickly
got it.
go through. We have done this 38, right? Yeah. Sorry. Sorry.
30 is done. 35 is done. 36.
Okay.
36.
That's 36.
36.
Yeah. Go ahead. Go ahead, sir. What is not available? Easy. Yeah. Interest rate features
D.
not available in the Indian equity market. Correct. Yes. Got
So
it.
interest
See,
is also traded, right? My
but it
understanding
is
is
not
like
available. It's not available.
for retail traders. That's what you mean, or
On the Indian equity derivatives, these are the 3 months that are available for us. It's not available for us.
Okay.
Yeah. Next, 37. Case of futures contract, profit or losses are received. I paid only on maturity. Statement is true or false. Very good. True or false? True. Kaise hai true? See, let's revise this concept here a little bit here, right? What did we talk about? This is the concept we discussed. Go back to the, see, this is what I keep telling. The whole questions revolve around the concepts that we discussed. See, imagine I have taken a futures contract today. Tomorrow, go back to Reliance, right? So say Reliance results were there on the Friday, right? And the results were really good. See, imagine, my Reliance future contract has gone up in the month of, on Monday. I want to take off the profit. I will close the position. Okay. The question what is asking is, do I have to wait until the maturity to get my money into my bank account, or will I get my money into bank account? I will get my money into bank account on Tuesday itself, right? What is the concept called?
closing the position.
Array. We discussed that word.
MTM.
Very good. Whoever said that? MTM, mark to market, right? What is mark to market? Even if I close the position today, even before even the expiry, my settlement will be done the next day itself. Okay. That is where the settlement mechanisms are there. They are very robust in the Indian market. Got it, sir? So here what is saying is the profits or losses are paid only on maturity, which is false. Everyone understood this concept here, right?
Yes.
We should not
Yes,
get
sir.
it wrong. Yeah. It's the same thing we discussed. I think if you're there from day one of the classes, we discussed this multiple times. Okay, next. This we have done anyways. N into n minus 1 by 2, 3. Okay. Okay. Over the counter options are always standardized.
False.
What is OTC? OTC are our forward contracts. They are not standardized. Answer is B. Very good. Next. Calendar spreads the car is basis risk and no market risk, hence margins are charged. Again, this may be discussed. Lower margins. Right, everyone. Calendar spreads have lower margins. Okay. Next. Long or short position in future contract can be closed by initiating the reverse trade.
True.
Yes. True.
True.
Very good. If following it right, please stop me if you want to revise the topic anytime. You after this concepts आपके दिमाग में होना चाहिए. That's it, right? You should just go blindly and clear this exam. Next. When it is said there is a cash settlement of an index future contract, it means the contract is settled in cash with no delivery of the underlying, whether it is true or false.
True.
Yes. Understood, everyone? We discussed this just now, few minutes ago. There is no deliveries, that generally happens. Okay, please, it's all cash settlements only. So the answer is true. Sorry. Okay, next. When a person enters into a forward contract, the loss that can occur on the position is
Unknown.
Loss is unlimited, so unknown.
This is a little tricky.
So what is CD?
I need to go back to this question again, right? So see, the answer here seems to be actually B, known. But we will revise this concept. I'm also taking a note. Even I'm little confused on this. Okay, I'll come back to you guys on this. Yeah, seems like known, but I also feel it's unknown. But let's see. I think it should be B as to be hedge. Forward contracts, but we don't do hedges. So don't bring in the hedge concept. But yeah, I will double check on this. Okay. Future price is higher than spot price of an underlying asset. We discussed this. This is theory concept, right? You should do this. Nice. It's called contango, right? What is reverse? What is reverse? If the future price is lower than the spot price, what is it called?
Backwardization.
Backwardization.
Got it. Perfect. Lovely. Just simple theory here, no brain lagana. What is index feature? Very thin, easy.
C.
It's a derivative product.
Derivative product.
Correct. Right. What is its false statement with respect to the trading at the OTC market? Okay, please go through the options carefully. He is asking false statement, not true statement.
False statement is A. OTC markets have centralized clearing and settlement of contracts.
Yeah. Just put it in the chat, but yeah. So the answer is A. What is happening here? The OTC, he is saying OTC has centralized clearing settlement, which is absolutely false. No, this is available for future contract. OTC is a forward contract. Okay. Now, there are low limits on the positions buyers and sellers take, which is true. Buyers and sellers can trade in tailor-made contracts, which is true. Risk management is usually the responsibility of the participants, which is also true. So the answer is A here. Okay. Next, future contract. Future contract
Can be squared off any time before expiry.
Answer is C. So just put it in the chart. Thanks. So it can be squared off anytime before the expiry. Very good. Lovely. Nice. 48. Let's do the equity and then we'll actually close the session. But 12 more questions. Let's finish this. Which of these derivative contracts once entered into usually cannot be closed or reversed till their expiry? Except the futures, forward contracts cannot be actually closed or reversed, till their expiry. Okay. Futures contracts can be closed at any point of time. Very good. You got it. D. Oh, next. This is little not tricky, but let's understand this here, right? So this is what is happening here, there is a market action that is happening. On the announcement of the record date for a merger or a demerger, for the company, the unexpired futures and options contracts of the underlying securities which are outstanding on the last come date, what is going to happen, to those contracts? Got it. Everyone is getting it. So once the demerger is happening, those contracts have to be settled on the settlement price on the last come date. They can't be further traded. Okay. Always remember this, guys. Okay. Those contracts cannot be extended because why? Simple reason. See, imagine, right? If there is a merger demerger. Yeah, there could be exactly. There could be volatility in the price discovery if the contracts remain open. It cannot remain open, and of course, because of the merger, right? Under what entities, etc., and all, and those legalities also come into the picture for you. Demerged entity also doesn't trade, but I'm also why it has come into the picture is I'm also talking couple of other scenarios. Kamal sir, got it, perfect. Okay. Let's move on. Price of 4-month futures is less than the price of near-month futures. It is called as, we just now did this, backwardation. Right, everyone? Yeah, backwardation. Future contracts are not symmetrical with respect to rights and obligations of the parties involved. Answer is true or false? False. Why? Have to respect both the buyer and seller here, because we are bringing in the standardization in the whole process, right? Everyone got it here? Any questions on this? It's the same thing. It all revolves around the same concepts only.
I didn't get exactly.
So what is he saying is the contracts are not symmetrical with respect to rights and obligations of the parties involved. So there is a buyer and seller. Do they have the equal rights or not in future contracts?
Yes.
So what is he saying? It's not symmetrical. So the answer is
False.
That's it.
I mean, true.
No. You said false, sir. That is your false is the true statement actually.
False. Yes.
Your false is the true statement. Yeah.
Yeah.
Okay. Next one. True or false? Scarcity of underlying commodity will generally cause a rise in futures price. Quickly. Yes, obviously, right? Always a demand supply issue. Whenever there is a demand supply mismatch, prices rise, right? Correct. Expiry date for June series index futures would be RAR. This is a little tricky, What will you do here? Oh, no. This can be done. This is standard only. Last Tuesday of every month, in the month of June. A as per book, by the way. A as per book, someone said that. Yeah. Okay. Let's quickly do this. Sells 1 ABC 268, lot size 1500, profit or loss if the purchases contract back at 274. Kamal sir, positive or negative?
Negative 9,000.
Negative sir, positive कैसे होता है?
Negative 9,000.
260 में बेच दिया था और 274 पे बाय किया था, उसको 268 260 जाना है, मगर क्या क्या हुआ उसको, 274 गया था. So that means first of all is making loss. What is the component there? $6, 6 times 1500 on the negative side. Yeah. Okay, next one. Case of forward contracts, rules regarding minimum amount by which the price would change and the price limits are specified by an authority. True or false? Forward contracts, forward contracts, forward contracts. Once you see the forward itself, you should say, array, no standardization. Answer is false. As simple as that. Don't put so much of brain and all into this, right? We have done this, you're seeing it, right? The same concept is getting repeated in multiple ulta formats, etc. and all. It's the same thing. Next. Futures price is rising, but open interest is declining. It indicates this you don't worry. I think I don't think we have covered this topic, but you can attempt it if you are a trader. Yeah, that's good. Actually, it is called short covering. I will cover this topic. It should come in the strategies part. Futures price is rising, but the open interest is declining. It actually indicates short covering by the way. Okay. Next. Tanisha has gone short on October futures at 2300. She'll make a profit if the price moves to. There is only one thing there. Yes. So, kitna easy hai exam?
When we are
22
there, it is easy, sir. When we are not there, then okay.
Come on. So only one thing, right? Short hona hai to kya hona hai? The price has to become less than 2300. The only option is 2250. Okay, so as simple as that. Next, last 3 questions for today. Cost of carry model, we did that. Spot price plus. No. Here, yeah. Cost of carry, price of futures equals to what? Spot price plus cost of carry, right? Always remember that. The answer is A. We've done this for as well. Okay. Now 59. Okay, this is little interesting question. Please let's go through this. We have done the demerger thing. In the case of the bonus share, the new option strike price is arrived at by the old strike price by the adjustment factor. What should happen here in the case of the bonus shares? Divide. Yes.
Subtracting.
Sir, subtracting kaise hota hai, sir? It's dividing. We're talking about the adjustment factors, right? The adjustment factors either mostly will be, dividing or not.
Yeah.
Okay, cool. Last one for the day. If the trader does a calendar spread in the index futures and the near leg of the calendar for the leg becomes a regular open position. Don't get it wrong. Yes, very good. Lovely. It becomes an open position, which is also called as a naked position. Got it? Cool. Awesome. So I think you should be able to crack, almost. These are all the questions from the equity part. And I wish we could do, but I think we covered everything. I think 60 questions and the next one is currency. I don't think we need to do
आपकी आवाज नहीं आ रही है सर.
Not hearing?
It's coming,
Can you
sir.
hear me?
Yeah.
Sir, check your mic. I mean, the sound.
We can hear you.
Okay, perfect. Okay. So I think
Sir, you'll be sharing this?
I will share this. I will share this along with the answers. I'll put it in the our Notion doc. Go through that.
Great.
I think these are the most of the questions that you will get in the equity part. This should be more than sufficient for you. What we will try to do tomorrow, let's get on to the concepts itself, right? Let's finish off.
आपकी आवाज नहीं आ रही है सर.
Sir, everyone can hear, sir. Everyone can hear.
Yes, sir, I am hearing. It is audible to me.
Yes, he need to check his
System.
System, yes. Yeah.
After 9, it won't be here, maybe.
Okay. Okay. So the action plan. Action plan is what we will try to do. Let me close that point.